Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is October 14th, 2018 edition of Market Outlook. So first, let's take a look at the key indices. Obviously, some pretty significant damage was done. Let's take a look at what I see here. So first of all, as you can see, the first thing is that IWM here has now closed significantly under the 200-day moving average. Also, note that the 50-day moving average is rolling over. Of course, the 10-day had been doing that for quite some time. Now, in terms of momentum, nasty breakdown. This is some of the lowest momentum we've had in quite some time. Now, conversely, you've got a scenario here where the Dow, right, is holding its 200-day moving average along with the Nasdaq. But momentum, as you can see, even as we made new highs in price, right, in late September and early October, we couldn't match it in terms of momentum. And in fact, our leading Nasdaq actually has the 50-day of real motion rolling over. Not a positive sign. So net, what I see here is significant weakness in momentum. Maybe you've got a couple of indices, the Dow, right, the big cap, and a lot of value stocks there holding up better. But overall, if you take it in aggregate, you definitely have done some significant damage. So at best, I see is a short-term rally. If it can muster that, a pop maybe back up to the 50-day moving averages across the board, maybe back up to the 200. But more important, all this area in here, in all these indices, are key resistance areas now, and it's going to take some time to work through it. This is not an automatic reset and just a V-bottom scenario as the data is showing us here. It's not an opinion. It's just that you can see that's the way it's set up. Now, on the weekly charts, you've got a slightly better scenario, but things really need to hold on right around these levels, or else you're going to have a very important momentum breakdown as well. And so what I'm highlighting here is, as you can see, right, at the moment, you're holding on the 200 week of real motion and above the rising 50 week moving averages. So net, the overall trend is intact until this swing low is taken out. That has not happened, right? So you've got highs in momentum here, and new highs and a failure in momentum, and we really need to take out that swing low to see that the momentum has really failed in our leading NASDAQ 100 index. You got a similar scenario here. You can see in the SPY, the breakdown in early 2018, momentum has not failed, although it's tenuous and barely holding on. The other thing to note, of course, is that the 200 week of real motion is starting to flip negative, right, with a slightly negative slope. So these are things to keep an eye on. But net, if you look at the overall picture, the trends are still intact on a weekly basis, but they are under attack. So there you have it. There's your scenario in the S&P. I can see, or in the key indices, sort of a potential bounce, and then ultimately another test. And that's going to tell you really what these markets are made out of. Now, furthermore, let's take a look at the S&P versus utilities. This is a key risk indicator. And as you can see here, when this red here, which is looking at the closing value of the ratio between the S&P and utilities, when that's above the two moving averages, that's a positive. And we really fell apart here. So risk off is definitely on. Now, the other thing that really gives me pause about the overall rally currently is the fact that the rally on Friday, right, from barely anything in the Russell to up to 2.78% in the NASDAQ and well over 1% in the other indices, had really, really light volume. So what we like to see is sort of a climax type of bottom with good volume and good volume to the upside. And you don't have that. In fact, volume is very, very light. You're down over 40% in terms of relative volume here. And of course, in terms of distribution, you can see the NASDAQ, the Russell, 4 distribution days, 1 accumulation over the last couple of weeks. So net, the volume here looking negative as well. The other thing to note, of course, is that year to date, the Russells, right, which is the best gauge of the U.S. economy because it contains 2,000 stocks that are almost entirely U.S. based, only up 0.75% year to date, hanging on by a thread. And what that means is that could be definitely putting a drag. We've been pointing out the divergence in momentum early on in IWM, and that was a drag on the overall market that the market seemed to ignore, but it finally succumbed. All right, so taking a look at sectors, that is also not really showing a positive sign. Look what's happened here. Year to date, you've got more sectors down than up on the year, right? This is a great table, and as you can see, year to date, you've only got a few sectors up, and most, right, as you can see, are down on the year, and the home builders, which are most sensitive to interest rates, down 21%. Now, on a relative basis, what was the strongest this week? Utilities, and that was still down 1.3%, considering the pressure on interest rates. So as interest rates rise, utilities are less attractive because people mostly buy utilities for the security in terms of their income. And again, what got hit really hard? Transportation, right? And the industrials as well. So you got some real negative performance here over the last 5 days, and that was even considering the very strong rally that we had on Friday, certainly in the NASDAQ stocks. All right, so that's sort of the picture now in terms of the overall market. One thing you can certainly see is things are definitely pummeled here on the downside. You can definitely get a potential bounce. Now, what I'm going to do is move on to the premium and get into a lot of the details of what I'm seeing in sort of short-term oversold readings and some other key points about interest rates and just what is happening in commodities and gold as well. So see you in the next series here if you are subscribed to the premium version.